we're going to talk about some of the standard policy provisions adopted by the National Association of Insurance Commissioners. Now, this is going to be a series of videos here, but I'm going to give them to you a few at a time so that you don't have to like watch a hour-long video just to learn them all. So the first one that we're going to go over is the entire contract. So the entire contract in an insurance policy includes the policy itself, a copy of the application, and any riders and amendments or endorsements. Okay, so it's the actual policy that says, hey, like this is what you have, and then the application that was submitted to the carrier. So that's included in the final policy as well. Okay, and then also any riders. So a rider is something that's added to a policy. So say you get like a whole life policy, and then some whole life policies have the option to add a term to it, almost like a little bonus, an accessory, right? You can add that. Some have riders where they'll help cover like nursing homes. If you go to a nursing home, you can take some of the death benefit to help cover that. They'll advance it to you ahead of time. So a rider is like an attachment to a policy, and an amendment or an endorsement. It could be a change that's needed or some sort of authorization that's needed on the policy after it's applied for. For instance, say you apply for like one rate and then you get rated down to another rate, then you have to have an amendment or an endorsement to make that change and authorize that change on that policy. So that's all included in this as a part of the standard policy provisions per se. There's no like nationally adopted like rule like you have to have all these, but this is just the standard that's followed. These are a few of the things. Now, don't forget to subscribe to my channel and turn on post notifications. I also have another channel for selling life insurance over the phone specifically. The name of my channel is, well, my name. Justin Von Eigen. I hire agents nationwide to sell life insurance 100% over the phone from the comfort of their own homes. We provide all the leads, full training, advancement opportunities, and a generous compensation plan. So if you'd like to learn more, just email me at jve@thejbe.com. The next one is the insuring clause. So the insuring clause says that like it gives a basic agreement between the insurance company and the person who is buying the insurance, the insured. Okay, and it just says that the insurance company will pay the claim if the insured dies, as long as they've made their premium payment. So some things that are included. This is usually on the face of the policy, like on the cover, on the first front face page of the policy, when it comes in the mail or when it's delivered. We mail ours because we sell all our insurance over the phone here at Senior Life Services. Oh, by the way, my agency, we sell 100% over the phone from home life insurance. So after you get in, if you'd like to learn, after you get in the business, if you'd like to learn how to sell insurance from home without having to drive around and go to appointments face to face, then just reach out to me. And also my company provides leads to all of our clients, our agents at no cost. So we provide the pipeline of clients so you don't have to like hit up your family and friends or buy leads or all that stuff. But anyways, the insuring clause, it says the premium of how much the insured has to pay, the death benefit. It has the duration of the policy and like what type of policy it is, if it's a whole life or a term policy or anything like that. And then it also says the parties of the contract. So maybe the beneficiaries, the insured, the owner, if it's different from the insured, the insurance carrier. Now we also have a free look period. So a free look period is a time, it's exactly what it is, a free look period. So it gives the insured a free look at their policy. It's like a refund period, right? It's like a refund policy, essentially. So it's like you buy a shirt and you get, 15 days to return it with the receipt for your cash back. And after that, you're stuck with it. So with the insurance policy in the state of Florida, it's a 14-day law. So they have 14 days to look at it once they receive the policy, not when it's issued. Okay, so the insurance company may issue the policy, then it takes a few days to get to the insured, and the insured gets it. At that point in the state of Florida, they have 14 days to review it. Now, every state's different. Some go to 10 days, some all the way up to 30 days. Insurance companies have their own policy with this stuff too. Like a lot of the carriers that we sell here, they have up to 30 days of a free look period. So even though the state that I live in has a 14-day free look period where the insured has 14 days to make any changes to the policy or request a full refund of their first payment if they made it with the application, our carriers that we sell give them 30 days. So that's usually on the right in the beginning of the policy as well. It states that. So what we just covered here is the entire contract, which once again includes the application, the policy itself, and any riders and amendments and endorsements. Okay. And none of those things can be changed once the policy's in effect without both parties agreeing to the change. So none of the things in the entire contract can be changed once it's solidified and set in stone. Okay. And then we had the insuring clause, which is just like the basic agreement between the insurance company and the insured saying, hey, if you die, we're going to pay the claim. And this is what your premium is, the death benefit. This is who's involved in the policy and stuff like that. And then we have the free look period, which is essentially the refund period for the life insurance policy. So if you found this content valuable, please like and comment on it, subscribe to my channel, turn on post notifications, and also share this with your friends who may be studying for the license course as well. And look, if you decide that you want to take a look at what we have to offer for insurance sales too, then reach out and I'll be more than happy to go over our program with you. I hope I help you pass your life insurance licensing exam course with this content. Thank you. All right, we're going to talk about 3 more policy provisions in this video. We're going to talk about consideration. We're going to talk about ownership rights and the owner's rights of the policy, the owner of the policy's rights, and we're going to talk about assignments. So consideration in the policy provisions is really like, what is each side putting up? So what are they offering? Okay, now the insured, the person whose life is being insured, they are offering in the consideration a promise that they will pay the premium every month or every year or whatever the premium payment mode is, how frequently they pay it. And also that everything they said in the application is truthful, and that everything was done, it was true and correct to the best of their knowledge and belief. Okay? So those are the 2 things in the consideration for the insured. And for the insurer, the insurance carrier, in the consideration, it's their promise to pay the claim if the insured dies. Okay? Now, next we move on to ownership rights and owner's rights. Now, there's really 4 parties in the purchase of a life insurance policy. So there's the owner. By the way, like the video, subscribe to my channel, and turn on post notifications if you find these videos valuable to you in helping you pass your insurance pre-licensing course. So you have a free look period. So owner's rights. So there's 4 parties in a policy, involved in a life insurance policy. So there's the insurer, which is the insurance company. There's the policy owner. There's the insured, and there's the beneficiary. Now, a lot of times the insured and the policy owner are the same 2 people. Also, sometimes there's a payor. So sometimes there's someone separate who pays the policy. But for your licensing exam, all you really got to know is that there's an insurance company, there's the person who's insured, there's the person who owns the policy, and then there's a beneficiary, the person who gets the money when the insured dies. Okay? So the only one who can really make changes to the policy is the policy owner. So the policy owner has exclusive rights to that policy, meaning they can change the beneficiary. They can receive living benefits like the terminal illness benefit in the policy where the money can be advanced to the owner if the insured is terminally ill. They have access to cash value. They can select the benefit payout option, meaning that they want it to be lump sum or do they want it to be paid in overtime, where the beneficiary gets payment installments. A lot of times they pay the policy premiums, and the policy owner has to have insurable interest in the person who the insurance is on when that person applies for insurance. So what insurable interest means, I have another video on this, but it really just means that if the insured, and you can search for it on my channel, it really just means that the person who's taking out the insurance on the insured has to have some vested interest in that person dying. Like they're going to sustain a loss if that person dies. So obviously, if the person getting the insurance is the owner and the insured, right? If the insured and the owner are the same person, like I'm taking out insurance on myself, then obviously I have insurable interest on myself. So what that means is like, I can't just go get life insurance on Jeff Bezos because he's rich. I can't just do that. I could get life insurance on Jeff Bezos if I was on the board of Amazon, because if he dies, then I want to make sure that he can be replaced. His human life value can be replaced. But you can't just go get life insurance on anybody. So they pay the policy premiums, and if the insured is not the policy owner, if someone else owned the policy, that's called third party ownership. So a lot of times that happens, like if a parent gets a policy on a child, the parent owned the policy, the child is the insured. It's third party ownership because someone other than the insured is owning the policy. Now, there is assignment of rights, so an assignment of ownership. So the owner of the insurance policy can transfer ownership assignment. They can transfer assignment of ownership to someone else. Now they can do this completely, and that's like complete full transfer. That's an absolute assignment, okay? And it has to be done in writing. So this doesn't say I own a policy on my son. If I had a child, I own the policy on my son. I could transfer the ownership to his mother, and it would not change the fact that he is insured. It just changes the owner of the policy. So at that point, I would no longer have access to the cash value. I couldn't change the beneficiary. She could. Okay, so you can transfer ownership in an absolute way when you transfer all rights of the policy. Now, there's an assignment provision of a policy that explains all this stuff. And you can also do collateral assignment. So collateral assignment involves partial transfer of rights. So this can usually be done to secure a loan or a transaction. So for example, say I have $1 million life insurance policy out on myself, okay? I have $1 million policy out on myself, and I want to transfer ownership, partial ownership to the bank, so that they can know that they're going to be the beneficiary of that money if they die. If I die, then I can do that to secure a loan, right? So say I get a big life insurance policy and I want to get a loan out. A lot of banks will require this if you take very, very large loans for you to get a life insurance policy. That way, if you die, they can have the money to satisfy what's remaining in the loan. So then once it's only partial assignment, collateral assignment. It's only a partial transfer of rights. Remember, it's called collateral assignment because the insurance policy is at like collateral for the loan in the event of your death. Once the debt or loan is repaid, the assigned rights are returned to the policy owner. So it's like a policy. You can partially transfer rights to someone under contingency that once that debt or loan is paid, then the rights come back. We're going to go over beneficiaries and how beneficiaries pertain to you passing your life insurance pre-licensing exam course. If you find value in this video and it helps you out, please like and subscribe to my channel and check out my other videos on passing your life insurance exam course. So the beneficiary is the person who receives the money when the insured dies. So when you have someone who has insurance on them and they die, then the beneficiary receives the proceeds of that life insurance policy. Now, there are two main types of beneficiaries. There's primary and there's contingent. The primary is the first person in line to receive the death benefit when the insured passes. The contingent is the next person in line if the primary insured dies before, if the primary beneficiary dies before the insured dies, then the contingent receives the money. I'll give you an example. Say Betty is married to John and they have a son named Matt. Betty can name John the primary beneficiary and Matt as the contingent beneficiary. So if John dies before Betty, then Matt is the new primary beneficiary as the contingent. If they're both alive, John and Matt, and John's the primary and Betty dies, John receives the money. If John dies before Betty dies, then Matt receives the money. There's also a tertiary beneficiary that you can name in case they can be a third level. There can be multiple primary beneficiaries, multiple contingent beneficiaries, and the insured can decide what percentage of the death benefit they want each primary beneficiary to receive or each contingent beneficiary if there's more than one. So for instance, say Betty wants to make John and Matt both primary beneficiaries. She can put Matt at 75% of the death benefit, and she can put John at the other 25%. So there's also two types of beneficiaries when it comes to revocable and irrevocable beneficiaries. So a revocable beneficiary is one that can be changed without consent of the beneficiary. So in that case, the policy owner can change who is the beneficiary without having to ask for permission. So they can just go in and change it whenever they want. They can change the beneficiaries whenever they want. If it's an irrevocable beneficiary, then the policy owner has to get permission from the beneficiary, written permission, before they can make a change to the beneficiary, or before they can take any cash value from that policy, or before they can assign ownership or assign that policy to someone else. So that irrevocable beneficiary does have power in that case. Now, there are rules set up to protect people if in the event that both the insured and the primary beneficiary die at the same time or in the same event. What's that called? That's called a common disaster. And there's actually a simultaneous death law. That's a mouthful. Simultaneous death law. What that means is that if both the insured and the primary beneficiary die at the same time or from the same event, then the contingent is the person who would be the beneficiary, not the estate of the primary beneficiary. So you can see that would come up. Let's look at the example from before. We have Betty and John. John is a primary beneficiary. Matt's a contingent beneficiary. If Betty and John die at the same time, then Matt now becomes a beneficiary, not John's estate. Okay? Now, in some insurance policies, there's a clause for this, and it's called the common disaster clause. And this is meant to protect the contingent beneficiary. Now, they can die separate times, too. So, like, for instance, say Betty and John are both in a earthquake, and Betty dies, and then John dies a few days later. Since they died in close proximity from the same event, then Matt is still the one who receives that benefit. So it wouldn't go to John's estate, right? You guys can see how that would arise. You can see, okay, well, would it go to the estate of the primary beneficiary, or would it go to the contingent beneficiary? So in that case, these rules protect the contingent beneficiary. So that's really what you have to know about beneficiaries when it comes down to your policy specifications and policy provisions. Don't forget to subscribe to my channel and turn on post notifications. I also have another channel for selling life insurance over the phone specifically. The name of my channel is, well, my name, Justin Von Eigen. I hire agents nationwide to sell life insurance 100% over the phone from the comfort of their own homes. We provide all the leads, full training, advancement opportunities, and a generous compensation. Hey, everybody, we're going to talk about 3 things related to passing your life insurance license exam course. The first thing we're going to talk about is premium payments. Then we're going to talk about reinstatement. And then we're going to talk about incontestability. So the first thing I'm going to cover is premium payments. Now, premium payments have to do with paying for your life insurance policy. Now, there are different modes of paying the premium. So when you hear modal premium, it means how is that payment being paid? All this really means is, are you paying it monthly? Are you paying it annually? Are you paying it semi-annually, like every 6 months? Are you paying it quarterly, every 3 months? So premium mode is just the frequency. How often are you paying that premium? And if you pay it anything more frequently than annually, you usually have to pay a little bit extra, because what happens is there's administrative costs and there's actual transaction costs that are involved that the insurance company wants you to pay for. Now, in addition to that, there is a grace period, which is usually like anywhere from 30 to 60 days, where after the payment is due, there's a period of time that the insured has the ability, that it's like a grace period to where they can make that premium payment before the policy lapses. Okay, so say like the payment's due and they don't on the 1st of the month, and the 15th of the month comes and they die and they haven't paid that premium yet. Well, the policy doesn't lapse the day that the premium is missed. Usually there's like a 30 to 60 day grace period where the client has that time to pay the premium. And obviously if they die in the grace period, then what happens is that premium is just taken out of the death benefit. Then there's also level and flexible premium. So a level premium is a premium that never changes. It's level throughout the life of the policy. Hey, stop it. And then there's, sorry, I got my little dogs here. And then there's a flexible premium, which the client can increase the premium or decrease the premium at will. So they can decide whether they want to put in more or less. You may see these on the universal life policies. By the way, guys, I have an agency. We sell life insurance 100% over the phone. We provide all the leads to our agents. So there's no cold calling, no talking to your friends, family, relatives. We focus on sales more than recruiting. We're not going to make you recruit everybody that you talk to. You can make sales from the comfort of your own home right through your computer. We provide you the full pipeline, all your leads, no driving around. It's really a state-of-the-art system. I make a bunch of money with this headset right here. And if you guys are interested in learning the program that we have to offer to take advantage of your life insurance license with, then just reach out to me at jve@thejve.com. My email is jve@thejve.com. So next we're going to talk about reinstatement. So if a policy lapses, then you can reinstate the policy. What this means is like the policy's lapsed and you want to put it back in force. So in order to reinstate a policy, you have to pay back due premiums plus interest usually, and you have to usually pay off any loans that are outstanding against the cash value, or against the death, loans against cash value if there's any outstanding loans. And then you also have to provide evidence of insurability. So you have to show that you're not like screwed up. You're not messed up to the point where you're not going to be insurable. Okay. So that's in there. So that you do have that ability in a life insurance plan to reinstate it if it does lapse, and people can do it, but you can't do it if like your health has changed or anything like that. So you have to show that you're still insurable, and you have to pay back any premiums that you miss. So say some companies allow for up to 3 years of reinstatement, but you have to pay back premiums for 3 years and show that nothing has changed in your health. You may have to go through underwriting again. And then the last thing I'm going to talk about is incontestability. So incontestability has to do with essentially the death benefit paying out. So anything after 2 years, if any insured dies after 2 years, then if there are any lies or material misrepresentations in the application, say the insured withheld something or lied about something or didn't even realize that there was something going on with them, and there was, if they die after 2 years of the policy being enforced, they have to pay the death benefit anyway. Now, exceptions to that are things related to age, gender, or identity. So if someone lies about their birthday and the insurance company doesn't pick up on it, and they're actually older or younger when they die, then the death benefit will usually adjust as such. If they were older than they say they were, the death benefit payout is going to be less, right? Because they were paying a premium that they should have been paying more. And if they were younger than they said they were, then they'd actually probably get more death benefit because they were saying they were older than they actually were. So they were overpaying on the insurance. And then if some people go through gender changes, I respect anybody, whatever anybody wants to do with their body, but insurance companies, they don't really care. So they look at gender at birth. So if a man decides he's a woman, then when she dies, the insurance company says you were a male at birth and genetically, so that's how the life insurance company pays out. So there would be an adjustment of death benefit there. And then also if you lied about who you were, right? Like if you said you were this person and you're really not and you die, then they may actually not even pay the claim out at all. So however, there's another caveat to this. If the insured dies in the first 2 years of having that policy, then there is a contestability period. It's called contestability period, where the insurance carrier can actually challenge the claim and can contest it. And they can say, well, based on our underwriting, that person wasn't supposed to die this fast, so we're going to go do another check on all their health and everything else, all their records, to make sure that they weren't lying about anything. And then we're going to make sure that we can actually insure them. If you look up right here, you are going to see a video that explains all the different types of life insurance policies that you can get. So, and that you're going to need to know for your life insurance exam course. A policy loan is only available in policies that contain cash value. So, you can take out a loan from the insurance carrier in an amount up to maximum of whatever the cash value equals. Now, since it's a loan, it's not taxed as income. Okay, that's why a lot of people will like life insurance policies as tax safety nets or tax havens, because you can take out the money and there is no tax on it since it's a loan. However, there is interest to that loan that you can use to pay that loan over time. So when the insured dies, any outstanding balance on the policy loan comes out of the death benefit. And a policy loan can only make a policy lapse if the loan is greater than the amount of cash value that the policy has. So let me go over that again here. Say the death benefit is $1 million and they have a loan against the cash value for $100,000. That means when they die, that $100,000 comes out of the death benefit, okay? And any outstanding interest. And say that the cash value in the policy is $200,000, and because they're not making payments back on the loan, the interest brought that $100,000 cash value loan up above $200,000, then the policy can lapse. Now, loan requests can be deferred, but they usually aren't. Now, what that means is the insurance company can defer the request for the loan, I think for like up to 6 months or something like that. Now, there's another type of loan called an automatic premium loan. Now, an automatic premium loan is never put through the loan is never put off. What this is, it allows the insured a safety so that they won't lapse their policy if there's enough cash value in there to pay for a premium. So say they miss their premium and the grace period expires. Instead of the policy lapsing, if there's enough money in the cash value to cover whatever their premium is, then that cash value will cover that premium. So some people actually use this as a way, once their cash value gets big enough, there's enough interest accumulating on that money to pay for the premium itself, okay? So say like that $1 million example I had before, say they have $1 million policy and it's $1,000 a month, and say they have $200,000 in cash value, and they're earning enough interest to, pay a big chunk of their premium, or maybe pay the whole thing. So maybe they're earning enough interest to pay the whole thing at that point. Now they can just use that interest to pay off their premium, or take some of the cash value to pay their premium instead of having to pay it out of their pocket. So that's just an option that some people have, but companies have this in place to help prevent the lapsing of a policy. So here we covered policy loans, the basics of it in a policy provision, and now there is an interest rate, a minimum interest rate that is charged to the loan. So it depends. Every company varies on what their interest rate is. I'm not going to say what the rates would be because that may date this video, but there is an interest rate, and that is in the policy. Usually it says what the interest rate will be if they borrow against it, and if someone needs to find out, they can always just call the company and figure it out. But there is an interest rate on any money that's borrowed as cash value. So as you're paying back the money that's borrowed from the cash value, you also have to pay interest on the loan. Now, there are some exclusions in life insurance policies that you'll need to know about to pass your life insurance exam course. If you find value in this video, subscribe to my channel and turn on post notifications. My whole channel is designed to help you pass your life insurance licensing exam. So there's some risks that the company won't cover. For instance, aviation is one, right? These are exclusions. So they say, hey, if you are on an airplane that's piloted by someone who's not a professional airliner pilot, like a commercial airline pilot, and you die, we may not cover that death benefit. If you have a hazardous job, like if you train skydiving, or you like to skydive frequently, or you're a mountain climber, or you like to swim with sharks or something like that, like they may not cover the death benefit if you die in that type of situation, or you'll have to pay a higher premium if you have a risky job. Now, there are also war or military exclusions. What these usually is, sometimes insurance companies will exclude deaths of active duty military, or if someone dies in an act of war, but that's not common anymore. Usually they're included, or they may not insure someone at all. Like the insurance company can make that distinction if they're going to insure someone who's in the military or who's going to war. And then also suicide. So there's a clause to protect the company against suicide. So if someone buys a policy and they commit suicide within the first 2 years of that policy being enforced, the death benefit will not pay out. If 2 years pass and then they commit suicide, then the death benefit will pay out. So I covered some things there that are exclusions. And things that life insurance companies put in their policy provisions that they won't cover. Not all these are included in every policy, but these are just some examples. So there are some that are standard, which is like usually aviation and hazardous jobs. And then sometimes there's things about war or military in there. And then suicide, there is a suicide clause in there as well. So I hope this helped you guys. Please, if you find value in this, subscribe to my channel and check out my other channel, which you can find a link to in the description, where I teach you how to sell life insurance over the phone without ever having to drive around door to door.